Warren Buffett, a symbol of financial wisdom, offers timeless and practical advice. This is particularly crucial for those entering middle age, a critical period for securing retirement. As the need for smart financial planning becomes urgent, Buffett's principles serve as a powerful guide. They offer a clear path to building wealth and ensuring a stable future. For anyone determined to prepare for a secure retirement, here are 5 essential pieces of advice from the legendary investor to put into action. Advice 1. Save and invest early and consistently. One of the most powerful principles of personal finance lies in the ability to harness compound interest, a concept that's simple yet profoundly effective. Compound interest is the process by which earnings on an investment are reinvested to generate even more earnings over time. As the years pass, both the original capital and its accumulated gains grow exponentially, creating a snowball effect that's nearly impossible to replicate if you wait too long or rely solely on large one-time investments. That's why starting early, even with a small amount, and committing to saving and investing consistently every month and every year can lead to remarkable long-term wealth accumulation. This concept is especially crucial for Americans aged 35 and above, a stage in life where careers have generally stabilized, income has begun to rise, and it's the perfect time to start planning for retirement. At this age, many begin to fully realize the importance of a long-term financial strategy to ensure a peaceful life after they've stopped working. As Warren Buffett wisely pointed out, the key to avoiding the pressure of having to accumulate a massive fortune in a short period is to start early with small, consistent investments. In practice, many Americans have embraced this principle through popular retirement savings programs like the 401k or IRA. These retirement accounts are designed to help workers build long-term wealth while benefiting from tax advantages that maximize investment returns. For instance, with a 401k plan, employees can contribute a portion of their monthly income into a retirement investment fund, often with matching contributions from their employers. Thanks to this system, even individuals starting with modest salaries or small savings can still accumulate a significant retirement fund over time, leveraging the power of compound growth and disciplined contributions. The greatest advantage of saving and investing early and consistently is not only the compound interest, but also the financial discipline it instills. The habit of setting aside money every month reinforces smart spending habits, reduces waste, and builds a strong financial foundation. Research shows that those who adopt early and consistent saving habits are significantly less likely to face financial pressure during retirement. They are more likely to enjoy a comfortable, stress-free lifestyle without constantly worrying about everyday expenses. Beyond that, regular investing also helps mitigate the risk of market volatility. Rather than trying to time the market, buying and selling stocks at the perfect moment, consistent contributions allow you to purchase investments at various price points over time. This strategy, known as dollar-cost averaging, helps smooth out the highs and lows of the market. It's a widely used approach in 401k and IRA plans to protect portfolios from sudden downturns. The greatest benefit of Buffett's advice to save and invest early is the creation of a stable source of passive income in retirement. Once you've built up a solid retirement fund or investment portfolio, that money continues to grow or can be withdrawn to cover living expenses without depleting your principal. This reduces financial strain, offers peace of mind, and allows you to truly enjoy retirement without the burden of earning a paycheck. Additionally, starting early creates flexibility in choosing your retirement lifestyle. With a secure financial foundation, you're free to live where you want, pursue hobbies, or spend more time with loved ones without being constrained by money. Warren Buffett's advice to save and invest early and consistently is a practical and highly effective strategy for anyone in middle age looking to build a secure, stable, and fulfilling retirement. Start early, stay consistent, use common low-cost tools. These are the non-negotiable steps to building long-term financial security. It's the key to easing financial anxiety, ensuring passive income, and living out your golden years the way they were meant to be: free, comfortable, and secure. Advice 2. Diversify your investment portfolio. One of the most important pieces of advice Warren Buffett offers to those approaching retirement is simple yet profound. Never put all your eggs in one basket. This timeless saying is the foundation of portfolio diversification, a smart strategy to protect your assets and ensure long-term financial stability. At its core, diversification means spreading your money across a variety of asset classes, such as stocks, bonds, ETFs, and cash, instead of concentrating everything in one place. This is a critical feature in mitigating risk during market volatility. The truth is, no asset class performs consistently well every single year. Some years stocks soar, other times they crash hard. Bonds and ETFs may offer more stability, but typically at the cost of lower returns. When you combine these asset types strategically, you create a balanced portfolio, one that can weather short-term turbulence and continue growing steadily over time. The most immediate benefit of diversification is reducing overall risk. Instead of living in fear of losing everything if a single stock tanks, investors can rest easier knowing that other parts of their portfolio, like bonds or cash, are still holding value. This becomes especially important during middle age, when preserving asset value and maintaining steady cash flow takes precedence over chasing high returns. Over the long run, diversification offers something even more valuable: financial security in retirement. A well-allocated portfolio reduces financial risk and can provide a consistent stream of passive income, supporting living expenses, medical costs, and unexpected bills when you're no longer working full-time. It gives you the freedom to enjoy retirement with peace of mind and financial independence. In practice, one of the most widely adopted models among long-term investors is the 60-40 allocation, 60% in stocks and 40% in bonds. This ratio balances growth with stability and has been tested through various economic cycles. Additionally, low-cost ETFs that provide broad market exposure are ideal for those who don't have the time or desire to track individual stocks. Diversifying your investment portfolio isn't just sound financial advice. It's your shield against uncertainty. For middle-aged Americans preparing for retirement, now is the perfect time to reevaluate your current portfolio, consider reallocation, and make sure you're on the right path toward financial security and freedom in the years ahead. Advice 3. Eliminate bad debt and control spending. In middle age, as retirement draws nearer, building a solid financial foundation becomes absolutely critical. This is no longer the time for risky experiments. It's time to consolidate, organize your cash flow, and ensure every dollar is accounted for. One of the most powerful pieces of wisdom from Warren Buffett is eliminate bad debt and control spending. This isn't just a casual reminder. It's a fundamental principle for achieving a stress-free, stable retirement. The key point here is to avoid high-interest consumer debt, especially credit card debt. These debts often come with punishing interest rates ranging from 20% to 25% annually, far exceeding average returns from long-term investments like stocks or ETFs. And yet, many people mistakenly believe they can beat the market with short-term plays while ignoring the debts that are silently eating away at their wealth. The reality is, you can't truly build wealth if you're drowning in interest payments every month from uncontrolled spending. That's why Buffett consistently encourages a simple yet powerful financial strategy. Live below your means, control your spending, and prioritize paying off bad debt as soon as possible. This is the true strength of his advice. It pushes you toward a healthy and sustainable financial lifestyle. The moment you cut unnecessary expenses and reject reckless borrowing, you'll immediately see a positive shift in your personal cash flow. No more burdensome interest payments, no more monthly panic about credit card bills. Instead, you'll finally start to see your potential for saving and investing clearly. The greatest advantage of managing debt and spending well is achieving stable, positive cash flow. meaning you consistently have money left over each month after covering all essential expenses. That surplus can then be used for long-term investments, additional 401k contributions, expanding your portfolio with ETFs or bonds, or simply building your emergency fund. This isn't just about short-term stability, it's about building a financially secure future. Equally important, eliminating high-interest debt dramatically improves your financial peace of mind. You gain the ability to make investment decisions with logic, not desperation. Studies show that people without bad debt are more likely to invest long-term successfully because they're not forced to sell assets during downturns. This matters even more in retirement when maintaining your assets and income stream becomes essential. In summary, Warren Buffett's advice to eliminate bad debt and control spending isn't just a defensive move, it's a launch pad for building lasting wealth. For people in their middle years, now is the ideal time to restructure your finances, cut out what's draining your wealth, and build strong, sustainable financial habits. In an economy that never stops shifting, your greatest competitive edge is personal financial stability. And it's the key to enjoying a peaceful and empowered retirement. Advice 4. Focus on low-cost investments. As people enter middle age, the pressure to prepare for retirement becomes more tangible. It's no longer just about saving money. It's about optimizing every financial decision to ensure that each dollar works as efficiently as possible. Among the many invaluable financial principles shared by legendary investor Warren Buffett, one of the most critical is this: focus on low-cost investments. It's a simple yet profoundly effective strategy, especially for those approaching their golden years. The most obvious benefit of choosing low-cost investments is the ability to retain more of your returns. Imagine investing $100,000 into a fund that earns an average of 7% annually. After 30 years, that investment could grow to over $760,000. But if the fund charges a 1.5% annual fee instead of 0.1%, your final return could be slashed by more than $200,000, simply due to excessive management costs. That's the hidden cost many investors overlook, and one of the key reasons Warren Buffett consistently urges individuals to stay away from overly complex, expensive investment vehicles. For many investors, time is no longer a luxury. With retirement drawing nearer, minimizing investment costs becomes even more crucial. Rather than chasing hot investment trends or paying hefty fees to financial advisors, a more effective and sustainable approach is to build a simple, low-cost, and stable portfolio. ETFs and index funds are ideal choices here. These funds typically track major market indexes like the S&P 500, meaning you don't have to pick the right stocks to benefit from the market's overall growth. The long-term advantage of this strategy lies in its ability to build wealth without being eroded by unnecessary fees. By investing in low-cost funds, you allow compound interest to do its work with full force. And when you stick with this approach year after year, the results can far exceed your expectations. It's also a reliable way to maintain financial stability without being thrown off course by market fluctuations or performance-based fee structures commonly found in actively managed funds. Another key advantage of low-cost funds is their transparency and simplicity. You can easily track performance, understand the portfolio composition, and avoid the confusion and anxiety that often accompany more complex trading strategies. This clarity enables better financial planning, more accurate cash flow projections, and overall greater control over your finances. In contrast, many high-fee, complicated funds demand advanced knowledge and often leave investors overwhelmed by a sea of unnecessary decisions. Additionally, choosing low-cost funds helps reduce emotional and psychological risks in investing. During periods of market volatility, investors with simple, low-fee portfolios tend to stay calmer than those involved in complex funds that require constant adjustments. When you know you're not paying excessive hidden fees, it's easier to stay confident and committed to your investment plan. Ultimately, focusing on low-cost investments reflects the core philosophy of Warren Buffett. Investing should be simple, easy to understand, and cost-efficient. In countless speeches, he's emphasized that average investors don't need to become experts to succeed. What they do need is the discipline to stick with a long-term strategy, avoid unnecessary fees, and let time do the heavy lifting. Advice 5. Create and regularly update a financial plan. As people reach middle age, many begin to realize that the time left to prepare for retirement is growing shorter. This is a critical turning point, the moment to build a smart, solid financial strategy that ensures security, stability, and control in the years ahead. One of the most essential elements of that journey is having a financial plan, and more importantly, keeping it updated as life evolves. A financial plan is far more than a rough estimate of income and expenses. It is a comprehensive roadmap for long-term financial goals. From estimating post-retirement spending to asset allocation, risk assessment, inflation projections, and planning the distribution of income sources like pensions, investments, savings accounts, and Social Security. A strong plan paints a full picture of your finances, from now through retirement and beyond. But creating a plan once and forgetting about it isn't enough. Life changes, costs go up, markets fluctuate, and unexpected events like illness or job loss can shake up your finances. That's why updating and reviewing your financial plan at least once a year is just as important as building it in the first place, to make sure it still reflects your current reality. By reviewing your plan regularly, you stay in control no matter what happens. Rather than reacting passively to change, you can make timely adjustments. For example, if a downturn in the stock market hits your portfolio, an updated plan can help you spot the impact early and rebalance, perhaps by shifting more assets into low-volatility ETFs or increasing your bond holdings. If medical costs or your child's tuition exceeds expectations, you can revise your savings target or consider extending your working years to stay financially on track. This is why financial planning and regular updates aren't just theoretical advice, they're practical tools that millions of Americans use to manage their money more effectively. In fact, many middle-aged Americans use personal finance tools like Mint, You Need a Budget, YNAB, or retirement planning calculators offered by companies like Fidelity, Vanguard, or Charles Schwab. These tools help users define how much they need for retirement, understand where they are on that path, and identify the adjustments needed to reach their goals. Some even work with certified financial planners, CFPs, for clearer, customized strategies that evolve with market shifts or life changes. One of the most powerful benefits of maintaining a financial plan is emotional control and reduced financial stress. When you know exactly where you stand and what steps to take, economic news or market volatility loses its power to throw you off. You know your strategy was built intentionally, and any changes you make are proactive, not panicked. This emotional stability is especially vital for those in midlife, who often juggle personal expenses, college costs for their children, and preparations for their own retirement. A financial plan that's reviewed regularly becomes a source of calm, a compass that keeps you grounded in uncertainty. The long-term benefit? Peace of mind and confidence. You won't lie awake wondering if you can afford a surprise medical bill or whether your retirement savings are enough. A well-maintained financial plan answers those questions before they even arise. It also helps you adjust your expectations and live in financial reality without sacrificing your desired quality of life. By reviewing and revising it regularly, you ensure that your retirement plan is more than just a dream. It becomes a tangible, achievable path. A great example of this in action is a strategy used by many American investors. Setting savings goals by phase, reassessing their investment portfolio annually, and adjusting asset allocation as they age and their risk tolerance shifts. At age 50, their portfolio might still lean heavily towards stocks to maximize growth. But as they approach 60, they gradually shift towards bonds and low-cost funds to preserve what they've built. These decisions are all guided by a plan that was created early and updated consistently over time. Thank you for taking the time to watch this video. We hope the financial wisdom of Warren Buffett has offered helpful direction, especially for those of you entering midlife to prepare for a retirement of financial freedom and peace of mind. If you found this content helpful, feel free to share your thoughts or questions in the comments below. We're always striving to build a community where we can learn and grow together. See you in the next video with energy, optimism, and ownership of your future.